In today's stock pick series, we will give you some tips on how you can use 3 indicators not taught in your typical textbooks to identify a fundamentally good stock selling at fair value that could potentially bag you a multiple-fold return in the long run. Hello everyone, welcome back to STA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high-quality tutorials, guides, and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and be the first to access these valuable resources, hit that subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here is a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. Today, let us talk about Hershey's. You all know that favorite childhood chocolate sold at your candy store? I'm sure most of you would have heard of Hershey's. So, why do I think Hershey's might be a potential breakout stock? Let us deep dive further to look at why Hershey's returns might have underperformed the market and how I identified 3 valuable indicators to determine if Hershey's is a potential breakout stock. Hershey's has recently announced its quarterly earnings that had beat street expectations. Its first quarter 2024 sales revenue saw an increase of 8.9%, while adjusted earnings per share is up 3.7% at $3.07 per share. Despite the better than expected results released, Hershey's is currently down 3.65% for the past month since its last earning announcement. Why is this so? Let us first take a look at the US core inflation rate. Even though inflation has come down since its peak in 2022, inflation remains sticky at the 3% range. Core consumer prices have also gone up and is now at its record highs. These factors usually affect gross margins in the food processing business, like Hershey's. Inflationary pressures have also brought about increases in cost prices, such as cocoa and sugar. These are the raw materials required to make the finished chocolate product we all see in the candy stores. Any increase in such raw materials costs will lower profits potential for Hershey's. We believe that the outlook by the investment community has been subdued due to these pressures, thereby causing the stock price of Hershey's and its competitors to be muted. These pressures are bumped up further with the current uncertainty in the macro environment, characterized by political and geopolitical uncertainties from the US election. Let us take a look at this chart dated October 2023 to July 2024. The total returns of Hershey's versus the S&P 500 total return and the US consumer staples sector index returns. You will see that the returns on Hershey's has indeed underperformed both indices in the last 244 days. Is this therefore a cause for fear? Should we buy into Hershey's on the dip? Let's see how these 3 indicators tell us whether Hershey's is a good buy on the dip or not. First, let us take a look at Hershey's return on capital employed. The return on capital employed, or ROCE, is a profitability ratio that measures how efficiently the company is using its total capital to generate profits. To calculate the ROCE, we must first use the company's earnings before interest and taxes and divide it by the total assets minus its current liabilities. This will tell us whether Hershey's is employing its capital efficiently. Hershey's has currently an ROCE of 32% versus an industry average of only 11%. This is rather impressive, as Hershey's has not only managed to beat the industry average, but also shows that Hershey's can continually reinvest its money at such appealing rates of return. Another interesting thing about Hershey's is its ability to continually compound its ROCE year after year, bringing the 5-year total compounding rate on its ROCE to 49% if held over the last 5-year period. Not many companies can do this. We now look at the second indicator, Hershey's net operating margins from 2018 to 2023. This is an important indicator as the net operating margins can determine the earnings power of the company. The higher the net operating margins, the higher the earnings power and the stronger the defensive mode. With such consistently high net operating margins, as an investor, you need not worry about any intense competition eating into the Hershey's economic pie. Since 2018, Hershey's margins have been ranging around the mid double digits very consistently. Therefore, this gives me the conviction that Hershey's is in a highly defensive position if measured relatively against the industry, which generally has a net margin around the 8 to 15% range. Let us now take a look at the third and final indicator. In this chart, you will find that Hershey's has managed to grow its earnings per share year on year consistently. This is indeed not an easy feat to achieve, as many of Hershey's competitors have seen their earnings decline due to the inflationary pressures. Another important thing to notice from this chart is how Hershey's actually performed during a crisis, such as the COVID, where most countries have been in a lockdown and most factory production temporarily ceased due to these lockdowns. Hershey's, on the other hand, managed to grow its earnings per share despite the difficult COVID period. How did they do this? This is because Hershey's business model is resilient and has a strong management team to steer the company. Their stellar result is a byproduct of Hershey's disciplined capital investment approach by continuously developing its enterprise resource planning software to streamline operations. Looking at all the three fundamental indicators that we mentioned earlier in this video, we think that Hershey's has a strong potential to continue to grow its capital with above average growth rates and should benefit shareholders' returns sustainably in the long run. So, stay tuned and see you in our next video. Goodbye.